Hi, it's Lee, and welcome to the Tech Economist. All right, a little bit of much needed relief today in the market. Hopefully, now Elon has stopped selling, and the stock price can recover a bit. The stock price can be really tough to deal with as an indicator to the success of your investment. But all you business owners out there, if you kept seeing your company grow like this, with such a popular product, and absolutely still no signs of any competition catching up to you, then you would likely still be pretty happy with your business, even if there were people out there trying to shout out lowball offers as to what your business is worth, aka the market. I do what I can to ignore market noise and just take the viewpoint of if it was a business I owned rather than simply an investment worth some arbitrary amount at any time. So keeping with that perspective, I thought we could take a rough conservative look at what Q4 might be in earnings, and then just use that to give us an idea of how far a stretch the stock price has really gone in unrealistic terms of valuation. Now, before you mention it's to do with Twitter or Elon, I think that will all pass. And I also bet that if Tesla's stock price was running up right now, then the sentiment would be the opposite. We're acting negatively because the stock is, which, let's face it, is mostly macro-driven right now anyway. To be clear, this is not an in-depth analysis on what Q4 might be. This is me kind of taking a more bearish approach as to just roughly what it could be. And I don't want to get your hopes up, but also try and place in some reality at the same time. Q2 and Q3 suffered, and the market doesn't care why. We know why. But the market doesn't have time to analyze Tesla to the minute details we do. But a quick recap. Q2 had lockdowns and some savage expenses from the new factories, and Q3 had a ramp up, meaning the lines were down, and logistic issues that resulted in 6% of vehicles not even being delivered, despite the same OPEX, whether they were or not. On top of that, Q4 always being the biggest quarter for autos, so let's see what we can find out. Alright, I've added in some delivery numbers. I think this is fairly conservative, especially for me, and I think production will be much more. But I'm going to have a discrepancy again of about 20,000 additional vehicles that were produced and not delivered due to the new logistics model. Bearing in mind that there are something like over 30,000 vehicles in inventory right now that Tesla could decide to really push out if they wanted to have a crazy Q4. So there could be an additional 50,000 in deliveries here. Not that I think it's likely, just saying. Historically, Tesla has pushed the hardest in Q4, as it is the biggest selling quarter and of course the end of the year. For Fremont, I'm giving 145,000 deliveries. They're meant to have ramped up a bit more, really. 145,000 is about the same last quarter. Also, we have employees from Giga Shanghai going over to Fremont to presumably find more ways of ramping up that factory. I mean, they managed to increase output by 30% with line upgrades just recently in Shanghai. We would expect there could be something that could be done for Fremont too then. Although that might result in the line being down for a couple of weeks too. But if Tesla are ever going to, now is the time before the tax credits kick in. But no news about Fremont downtime that I've heard. Alright, next China. As I said, we have had a 30% ramp up in production with these new line upgrades. And we saw record production at 82,000 in September as a result. That's almost a million a year. And now we have confirmation that the ramp continues, and we saw another record in production for October at 87,700. Now well over a million year run rate. This is fantastic news to see that Tesla really can produce that many vehicles in such a relatively small factory. No other car manufacturer is capable of this. The economies of scale that kick in are incredible. It means that Tesla are making vehicles at a lower average cost than before. Also, as numbers rise, the OPEX per vehicle reduces too. Of course, now the aggregate demand for autos has dropped in China. Tesla now need to find buyers elsewhere for these additional vehicles. But it seems there is still the demand, and Tesla are not limited by exports as people thought. I would say the production will continue to ramp up through the quarter still, and probably to something like 270,000 total with smooth sailing. We'll assume this quarter goes relatively smoothly in the way of lockdowns and things, but let's scale total Shanghai deliveries to just 240,000 for the quarter, as we're trying to be conservative. As for Berlin, we might get an average of 3,500 a week, so let's place 45,000 in there. And Texas is catching up too, so let's place 32,500 in there at an average of 2,500 a week. Now, last quarter, I was less than 1% off my ASPs. The euro is stronger than the dollar was back then now, so they may possibly have increased even. Same for the yuan. Also, prices in Fremont should be seeing more of the higher priced vehicles too. but obviously we have a price drop in China to deal with. Anyway, I dropped them all accordingly. Also, remember though, probably less than half of these vehicles will be sold in China, so the price doesn't account for all Chinese-made vehicles. And this gives us an ASP of $53,000. With FSD, we get a total revenue of $25 billion, up from $18.4 billion in Q3. All right, that is a significant increase in revenue, but let's see what profit we get. I'm still giving good margins from Fremont. Those prices are still up a lot and should see decent margins, but I'm dropping China margins to below 30%. Something to bear in mind last quarter, which I haven't heard anyone else mention, is the fact that the cost of these line upgrades in Shanghai all came out of costs of goods sold, which would have impacted margins. How much? We don't know. It wasn't mentioned on the earnings call either. And of course, margins should be up due to the factories being more efficient after this ramp. Then for the new factories, I mean, if they both had a positive gross margin at the end of last quarter, supposedly, and we're expecting around double production this quarter, I think 15 and 10% margins for Berlin and Texas accordingly could be realistic. This leaves us with a gross margin of 27% without regulatory credits, which does sound more realistic within the sentiment right now. The Tesla fanboy in me believes it could be higher, but I've been trying to silence that voice more lately during the less optimistic times, leaving us with a gross profit of $6.9 billion, compared to about $4.9 billion for Q3. When we had $250 million in regulatory credits, we hit a 28% margin. Energy should be up a bit. I don't know by how much. It's hard to say with the new facility running whilst it ramps up. So I won't go too crazy and just say $1.4 billion. Services and other should continue to rise a bit too. So let's say $1.8 billion there. However, the costs of both these sides of the business are still going to be relatively high and not giving the highest margins. However, we had a positive margin last quarter from the new Megapack facility, so that was a great sign. And I'll just raise OPEX a tiny bit for good measure. And then that leaves us with $5.7 billion in operating profit, over $2 billion more from Q3. Okay, I think that's pretty good. When we take out tax, we're left with $5.1 billion net profit, up 55% from Q3. And in a previous video, off the top of my head, I guessed it would be around 60%, so not too far off. And the all-important non-GAAP EPS is $1.57, up 50% from Q3. Now, I think that much of an increase, quarter over quarter, is going to be felt in the stock price. Surely that can't be ignored. And people are once again reminded of Tesla's magic, and confidence is restored. Possibly there's less negative attention on Twitter by that stage too, and Elon focuses the spotlight back to Tesla somewhat. I also didn't include the semi-truck deliveries, as they're going to be quite small anyway. Production could be a lot higher. I think there's an actual possibility it could be closer to 500,000, perhaps 490,000, if China continues at this rate, and the new factories ramp up as we hope. And time for the insanity. $5 billion annualized is $20 billion. Currently, the market cap is $580 billion. This is a PE ratio of 29 relative to this quarter. But also bear in mind, this still factors in likely 6 to 10% of production not even being delivered, which really should count, but the market doesn't seem to care so much. If this is a little bit on the bullish side for you, well, if I scale these numbers to just under 430,000 for deliveries, then we still get an EPS of $1.47, or 40% increase quarter over quarter. I still think the market is not going to expect that. But seriously, production from China is probably going to be closer to 270,000 if we're at 87,000 already in October, and that includes losing a little bit of time for China's main holiday, I think just one day, but still, these new lines are still being refined. Plus you might get 150,000 from Fremont. That's 430,000 already. Even if the other two just averaged 2,700 a week, then we hit 500,000 production. Like I've been saying for some time, Q4 has a lot going for it. And the previous 2 quarters have compressed people's realization of what production rate Tesla's at. Now, I'm not expecting this to put us back to 300 or something, but I think it will give us a stronger base for now at least. Q1 will get the tax credits in the US, which might help us there, but we might be trading around 220 to 240 for the time being. A more tolerable place to be at least, given what we've just gone through. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.